Student loan refinancing is a powerful financial tool that can help borrowers lower their interest rates and modify their repayment terms. However, it comes with important trade-offs that every borrower needs to understand before making a decision. Throughout this guide, you'll learn exactly when refinancing makes sense and what federal protections you might be giving up in the process. Refinancing means taking out a new private loan to pay off your existing student loans. Essentially, you're replacing your old loans with a brand new one that has different terms and interest rates. Think of it as starting fresh with a new lender who pays off all your previous loans, and now you owe that new lender instead. The new loan can have a lower interest rate, a different repayment period, or both, depending on your qualifications and the terms you choose. There are 4 main reasons why borrowers choose to refinance their student loans. First, you can secure a lower interest rate, which could save you thousands of dollars over the life of your loan. Second, refinancing lets you simplify your finances by combining multiple loans into one single monthly payment. Third, you have the flexibility to change your loan term, either shortening it to pay off debt faster or extending it to lower your monthly payments. Finally, refinancing can help you release a cosigner from your original loan once you qualify on your own, freeing them from the financial obligation. Refinancing works best in specific situations. It's ideal if you have good credit and a stable income, because lenders offer their best rates to qualified borrowers. It's particularly beneficial for those with private student loans that carry high interest rates. Refinancing also makes sense if you don't need federal loan protections or aren't planning to pursue forgiveness programs. Lastly, it's a smart move when you have a clear goal, whether that's paying off your debt faster or reducing your monthly payment burden to free up cash flow. Here's the most important thing to understand about refinancing. When you refinance federal student loans, they become private loans, and you permanently lose all federal protections and benefits. This is not reversible. Once you refinance federal loans into private loans, there's no way to convert them back to federal loans. This decision is permanent, so it's crucial to carefully consider whether you might need those federal protections in the future before you refinance. Let's talk about exactly what federal protections you lose when refinancing. First, you lose access to income-driven repayment plans, which cap your monthly payments at a percentage of your discretionary income. Second, you forfeit eligibility for public service loan forgiveness, which cancels remaining debt after 10 years of qualifying payments while working in public service. Third, you lose the ability to pause payments through deferment or forbearance during financial hardship or unemployment. Finally, federal loans are automatically discharged if the borrower passes away or becomes totally and permanently disabled, but private loans may not offer this protection. 3 main factors determine what interest rate you'll receive when refinancing. Your credit score is the most important factor, as higher scores unlock significantly lower rates. Lenders typically want to see a credit score in the mid-600s or higher for the best rates. Your income and employment history also matter because stable income demonstrates your ability to consistently repay the loan. Finally, the loan term length you choose affects your rate. Shorter repayment terms, like 5 or 7 years, typically come with lower interest rates compared to longer terms like 15 or 20 years. When refinancing, you'll need to choose between fixed and variable interest rates. A fixed rate stays exactly the same throughout your entire loan term, giving you predictable monthly payments and protection from interest rate increases. This stability makes budgeting easier. A variable rate, on the other hand, can change based on market conditions. Variable rates often start lower than fixed rates, which can be attractive. They could potentially decrease over time if market rates fall, but they can also increase, making your payments less predictable. Before you commit to refinancing, complete this essential checklist. First, compare rates from multiple lenders because rates can vary significantly between companies, and shopping around doesn't hurt your credit score if done within a short time frame. Second, thoroughly check whether you qualify for any federal loan forgiveness programs, because refinancing would make you ineligible. Third, calculate the total interest savings over the entire life of the loan, not just the monthly payment difference. Sometimes a lower monthly payment means paying more interest overall. Finally, honestly assess your job stability and emergency fund, because private loans offer less flexibility during financial hardship. Let's recap the most important points about student loan refinancing. Refinancing can absolutely save you money through lower interest rates, especially if you have strong credit and stable income. However, remember that you permanently lose federal protections when refinancing federal loans into private loans. Refinancing works best for borrowers with stable income, good credit scores, and private loans, or for those with federal loans who are confident they won't need federal benefits. Finally, always compare offers from multiple lenders and carefully calculate your total savings to make an informed decision. Refinancing is a powerful tool when used correctly, but it requires careful consideration of your individual circumstances.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.